Hi, I'm Seth Freuberg. I'm the Director of Options Training here at SMBU in Manhattan. I'm also the head trader of SMB's Options Trading Desk. So I would like to talk today about a trade that many of us in the options tribe utilize very often. It's called the Bearish Butterfly. It's actually a trade designed to be traded pretty much in any market environment, but there are certain market environments where it's more optimal for the trade than others. And so I'd like to talk a little bit about this trade in particular and some trading principles in general. Let's focus on the Bearish Butterfly. What is the premise of the Bearish Butterfly? And that is that no matter how much the market rallies, as it did in late February of 2014, here you can see the Russell 2000 ran up to almost around $1,200. By late March, it had sold off 40, 50 points into the 1150, 1160 area. So that was quite a rally initially on the Russell 2000, but it ultimately sold off. Now, that is the basic premise of the Bearish Butterfly. No matter how much the market rallies, the market will ultimately have some kind of profit taking, some kind of retracement. It may be deep, it may be shallow, but there's going to be a retracement at one point. So therefore, what is the design of the Bearish Butterfly? And the design of the Bearish Butterfly essentially is to start about 8 weeks out, 20 points behind the market, and it's traded on the Russell 2000 index. So if the Russell's, say, trading at 1120, then the Bearish Butterfly is initiated at 1100. Then if the market rallies, you keep adding butterflies. Generally speaking, there are some exceptions, but generally speaking, you're adding those butterflies behind the market again. So if the market rallies from 1120 to 1140, you might end up entering an 1120 butterfly, so you'd have then an 1100 and an 1120 butterfly. The most number of butterflies in a Bearish Butterfly is 3, so you can end up having a triple butterfly if the market keeps rallying and you keep entering those butterflies behind the market. So what happens, however, frequently with traders is that they have a certain amount of capital that they've dedicated to the options to the Bearish Butterfly, and they have not freed up that capital from their previous Bearish Butterfly trade, and so it has come time for the next month's expiration because you're always 8 weeks away or so from some expiration. So it comes to the point where it's time to put on the next butterfly, the next Bearish Butterfly for that next month, but your capital is not freed up yet, so you can't. So what do? One thing you do is you skip that next month. Now, some people will do that, and in certain cases that's very wise. But another thing that you can do is what I like to do, which is I like to model what the Bearish Butterfly's position would be had I entered it eight weeks before expiration. I did not, but I can model what it would have looked like had I done that. So let me give you a case in point. This current month, we should be, if you're following the guidelines, in the middle of the Bearish Butterfly for July. Now, it turns out that the Bearish Butterfly started 56 days out from the July monthly expiration, would have at this point, because the market has rallied quite a bit, would have been a triple butterfly. And the strikes of the triple butterfly would be as shown on the screen. If you finally freed your capital up, however, 6 days late, should you simply skip that month? Or what's an alternative? And the alternative is to place the exact trade that the Bearish Butterfly's position would be in had you entered it 8 weeks out. So in this case, we simply put on the 3 butterflies as a new trade. I call that a fresh start, meaning you do not have any drawdown. if the market rallies in a bearish butterfly, you're going to have drawdowns in the butterflies that you entered into. They're behind the market. They're very negative deltas. But if you enter the entire triple butterfly at once with no, with no baggage, what I call baggage, meaning previous drawdowns, then you're basically entering at very, very close to break even, minus your commissions and maybe some slippage. In this particular case, there was a butterfly that there was a drawdown of about $3,000 compared to entering at a fresh start, as you can see on the screen, with virtually no loss. You're seeing a little bit of a loss because of slippage and commissions, but otherwise the trade would have been down about $3,100 instead. If you enter it as a fresh start 6 days later in the full triple butterfly structure, which is where it would have been had you entered it on the proper date, then you would be down, basically nothing on the trade. Well, what does that mean? That means you're down. You have a $3,000 advantage over those who entered it 8 weeks out, and that's a big deal. And over time, that gets to be a very big deal as you start to add up the number of times that this occurs. So therefore, and to explain why that is, that's because the butterflies that you're buying, today, which have drawn down greatly, you're buying them at the much cheaper price. That's why there is such a difference in the P&L between the trade entered as a fresh start today and the trade entered previously as a new trade 8 weeks out. So why not just start the trade 50 days out? You might say, hey, okay, you're 6 days late. What's the big deal? And the answer is, you may be 6 days late, but if you have a bearish butterfly in a triple butterfly formation, that means the market has rallied quite a bit. According to the rules, probably has rallied 40 points since you put it on. Well, that means that the inevitable retracement is that much closer. Here's an axiom. The more the market rallies, the closer the market is to its retracement. That's just logic, right? So why not be positioned in the optimal way when you get that retracement? The bearish butterfly is designed so that capital is added as the market's rallying, so you have the maximum amount of capital in the trade at the time it becomes increasingly likely that the sell-off will occur. So every trade has its own premise. The premise of the bearish butterfly is the market, whenever it rallies, always retraces. Therefore, you should have the maximum capital in the trade at the time of the retracement. So therefore, if the market's rallying, that's actually the best time to get into the trade, because you'll get in very cheaply, your cost basis is much lower, and the probabilities of the market retracing into the body of the triple butterfly is increased, because axiomatically the rally, as the market rallies, you're that much closer to the sell-off, that much closer to the retracement. So sometimes you have to think out of the box a little bit. Instead of saying, well, I just freed up my capital today, I might as well, throw the first leg of my bearish butterfly on the trade right now. Think a little bit deeper sometimes and say, all right, the market, and this is really powerful, for example, if the market has really rallied and your capital just freed up. Under those circumstances, you may well want to think about getting into the full triple butterfly formation when that trade most likely is really drawn down and you're getting in basically at zero, a zero P&L after a strongly rallying market where the likelihood of a retracement is now getting more and more probable. So think about that. Every trade has a premise. If you understand the premise, you know how to take advantage of the circumstances that will be most advantageous for you. That's called being a trader, not a rule follower. A trader understands the premise of his trades, and therefore he knows how to take advantage of them. So thanks very much. Hope you understand this principle. Start to really dig deep into your strategies, understand the premise of those strategies, then you'll be able to take full advantage of the optimal circumstances for them. Thanks very much, and we'll see you next week. Well, if you just watched the previous video and find yourself interested in the bearish butterfly strategy, which is a very powerful strategy and a strategy that is used extensively on SMB's options trading desk, then you may want to consider taking a look at some more information about that course. And if you want to do so, two ways to do it. You can go to bearishbutterfly.com, or you can go to optionstribe.com, click on the links tab, search for Bearish Butterfly, and you can find it even more easily that way. That's our information page on the Bearish Butterfly. I suggest you check it out. Thanks.